Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax referral options. Not having a clear plan is the enemy, and using a proven tax referral strategy such as the deferred sales trust is an amazing way you could exit highly appreciated assets, defer capital gains taxes, and create and preserve more wealth, unlock some freedom from sometimes that frustrating 1031 exchange. My name is Brett Swartz, and each and every episode I'm joined by some of the best real estate, financial, and wealth minds in the world, where they share their ideas, deal stories, and inspiration. So together we make complex tax referral strategies simple and passive income plans achievable. I'm excited about our next guest. He's actually a repeat guest. He's out of the great state of Texas. He has advised on over $3.7 billion in capital financing and M&A transactions, as well as secured over $50 million in equity from private and institutional capital. He's a graduate from Rotham School of Business, and he's a CFA charter holder with 10 years of investing experience across real estate and commodities, and so much more. He's closed over $450 million in assets across Texas, Georgia, Florida, and South Dakota. Please welcome to the show with me, my friend and real estate extraordinaire, Omar Khan. Omar, how are you doing?
Thanks for having me here. How are you doing today? And by the way, congratulations for finally moving to Florida.
You know, it's a great place to be right now. And California, we still love you, but we are excited to be on the other coast. Mr. Omar, for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Well, the story is pretty simple. I like making money and I hate paying taxes. So my background is in investment banking and finance. So when I moved to the US from Canada, and what is it, like 8-10 years ago, we started looking around. I had a good background running deals, structuring deals, both on the corporate side as well as the investment banking side. I picked multifamily just because of a combination of scalability, tax advantages, and the ability that it was a very natural extension of my abilities in the past. So we've transacted now on over $600 million of transactions, gone full cycle on 5 of those deals. I think the average returns are like 22-25%, 2x equity multiple. So all in all, it's been a good ride. And now we're continuing to do more of the same. But you know, as your portfolio grows, as your needs grow, your teams grow, now we're a much different organization than we were even 5 or 8 years ago.
Absolutely. And Omar, by the way, if you want to learn more about Omar, go to boardwalkwealth.com. That's boardwalkwealth.com. Let's just dive in right into what we're seeing right now, uncovering hidden gems in fast-growing multifamily markets. Well, actually, before we go there, I actually want to do a little bit back up a little bit. Like, what are you seeing from 2022 to 2024, if anything has shifted really, right? And how are your deals doing in general with interest rates and debt? I know those that have owned multifamily are working out, you know, rate caps, different things like that. Walk us through just kind of your feeling for the overall, you know, $5 to $50 million multifamily owners as it pertains to debt and real estate and what's going on with multifamily.
So look, we have 2 verticals: acquisitions and developments. Developments, it's all fixed rate debt. That was by design. By the way, developments, we're actually doing all of them in South Dakota, Sioux Falls, and the Midwest. Very specific reasons for that. We'll get into it, but those are all doing really well. Acquisitions wise, there are certain, about I would say like 7 out of the 8 or 9 deals are doing great. I just want to touch wood so I don't curse myself. 1 or 2 are a little shaky. That's primarily because one of the counties that we've invested in unfortunately decided to change their rules, and it became a California light sort of model where you can't evict people, nothing gets approved. So still working through that. With regards to liquidity on the rate cap issue, look, for us, in good times, basically, I had always shored up a lot of liquidity. Now, I know this from personal and family experience. My family's a business family. So we had seen that, you know, when good times don't last forever, bad times, by the way, also don't last forever. So if you just sock up and save a lot, shore up your liquidity during the good times, and when inevitably the bad times come, you have something to rely on. So the liquidity aspect right now, thankfully, we have a lot of liquidity on the property. So with the rate cap and all of those issues that you hear about, that's now not as much of an issue for us.
That's excellent. That's great. And it makes sense. That's good wisdom, right? When things are going really, really well, shore up your liquidity, right? Perhaps getting really great debt positions. In other words, think about things that could go wrong and prepare for those. And then vice versa. Bad times won't last forever, right? So be willing and able to capitalize when deals make sense. Yeah. So talk about opportunities in general. Like, are you finding that the distress is here Is it coming? Do you feel like what is your temperature from 2023 fourth quarter, to where we're at right now, which is February 26th of 2024?
Look, the deal is that all this distress people think is going to be here or is here is not here. In fact, I've been talking to brokers, and we were all thinking heading into 2023, which was last year, oh, there's going to be a lot of distress, a lot of blood on the street. Nothing really happened. The thing that really happened is Class C assets and Class C locations, well, they're treading on thin water, but everything else, it's going by, right? Unless something catastrophic happens, lenders are extending and pretending, and people are figuring a way out to just keep the deal afloat. Now, obviously, these things can't last forever. So this year is going to be very telling to realize and see if rates stay up at the elevated level, are things actually going to go bad? But right now, any of this distress, any of this discount, or the massive discount rather, we're all expecting, that hasn't necessarily transpired. And a good reason for that is that the lenders are just not forcing their borrowers to do forced sales, basically.
Yeah, that makes sense. That's what I'm seeing too right now. And we anticipate 2024 will be the best buying opportunity for multifamily and real estate that we've seen in the past 10 years. But the question is, how much will that be off? I mean, from some of the highs, right? And I'm hearing 20%, I'm hearing 30%, but I'm also hearing capital that's coming in. And yeah, what do you think about that?
It's not 30%, man. Look, unless is there a one-off deal that somebody can possibly acquire at a 30% discount? Yeah, possibly. Look, one-off deals exist everywhere. But we're talking, when we say 20% off, 30% off, we mean averages, right? Or a good portion of the market. That's not happening anytime soon. Yeah. Now, again, to date, what we have seen. Now, if lender sentiment changes, as an example, or the Fed comes out and says, yeah, we're not taking rates down for the next year, yeah, things are going to unravel pretty quickly. But as of today, looking out, lenders have also learned their lessons from the last recessions and realized that if they basically put borrowers in a foreclosure, typically, not always, now every lender is different. So again, I'm not trying to make a sweeping statement here. It is in the lenders and borrowers' interest to basically continue to pretend basically that nothing is wrong and try to figure out an amicable solution, because the day a lender closes, they take this toxic asset on their books, and then now they got to deal with it. Because it's not like, a lot of borrowers are stupid people. It's just that events have transpired as such. Nobody predicted 500 plus basis points of increase. I mean, it's not just the private capital markets. We look at big guys like Blackstone, KKRs, Apollos, Carlyle's, Ares, and they have been caught flat-footed. I mean, I think Starwood, Barry Sternlicht is the founder and chairman of the company. I mean, Barry Sternlicht is as close to a real estate savant as you're going to get. And they are selling some of their loans off at a loss, and they've basically handed the keys back, because they're a diversified company, on some of their assets. So if those people, with all of their firepower, they're a $100 billion plus company, were caught flat-footed by this 500% historical rate increase, then this is a legitimate black swan event that nobody could have seen coming, basically.
Yeah, no, well said, Omar. And by the way, you can know more about Omar Khan by going to boardwalkwealth.com, boardwalkwealth.com. Now let's dive into the topic, now that we have that context, which is uncovering hidden gems in the fast-growing multifamily market. So what's the number one secret to doing that, Omar? And what are some of the markets that you're really finding to be attractive?
Well, the number one secret is that you have to be comfortable going against the tide and the grain of wherever people are going. So I'll give you our personal example. We were heavily concentrated in Texas, Georgia, Florida, Texas less. We've got 2 assets left in Florida and a couple assets left in Georgia. And this is about, I think 3 or 4 years ago. What we were seeing was that, everybody's bemoaning the fact that, more and more people are coming in. This is primarily because interest rates are zero. And we're seeing a lot of guys buy 60s, 70s vintage deals at 3% cap rates. And this is in California, right? Where, okay, whatever, maybe you have a reason for this. This is like suburban Atlanta, suburban Dallas, suburban, like, I don't know, San Antonio, pick a random Sunbelt state, right? Or Phoenix. And yeah, everybody thinks that their little town is like the next big thing. But let's be honest, if you're buying 3 caps, 4 caps of 70s vintage properties, I mean, guys are paying $280,000, $300,000 a unit in places like Phoenix. It's a race to the bottom, and you know how these things turn out. So what we did is we looked at the data, we pivoted aggressively to the Midwest, specifically Sioux Falls. We have 7 developments there because the reason is very simple. These are steady Eddie markets. So when we were looking out and say, I think late 2020, we were thinking to ourselves, again, we didn't know rates were going to go up this much. We're thinking to ourselves, what if the party ends over here? This is basically a situation where I'm not really comfortable. So why don't we start actually doing real economic research, start looking at markets that are coming up, but have been very stable across multiple business cycles. Median incomes are increasing exponentially. What are those markets? And within those markets, Sioux Falls shone through. So again, I live in Dallas. I'd love to do more deals in Dallas. I've got a whole bunch of deals in Georgia and Florida and 1 or 2 left in Texas, but the numbers weren't making sense. That's why we started developing there. We have been acquiring earlier. We started developing there. We have local partners. And those deals, by the grace of God, they're going great. We're constantly getting good rent upside. Leasing velocity is very tight. We're still getting basically great financing. But again, going against the grain, going against what everybody else was thinking, that was the key. And to be honest, like three years ago, when I was moving there and doing more developments there, I would have people ask me, like, why are you even doing this? Where is this place? What's going on? Are you crazy? Why don't you just buy another building in Atlanta or another building in San Antonio? And I mean, I tried explaining, but when people don't want to listen, they don't want to listen. And now every week I'm fielding calls from multiple family offices who want to partner with us. We've taken a few of them on. A couple of like big funds who say, okay, you've got 7 developments now. You've got a pipeline of 4 more on the way. Why don't we recap you? Why don't we work together? But these conversations, when I was having 3 years ago, when I was initially starting off, and that was my theory, yeah, people didn't want to listen because everybody was so enamored by buying the same garden style walk up 1980s vintage property and take a suburban location in the Sunbelt. And now all of those people are getting hammered, by the way.
Yeah. So it sounds like yeah, going against the grain, right? Going against just the traditional, but the big wave of Florida, Georgia, Texas are the main ones, right? Everyone buying there and going to places where the math made more sense because these 1670s vintage at three caps selling at 250,000 plus per door. You're going, look, I'm going to go develop brand new. And we're going to get much better return on equity, a little more steady markets in the overall grand scheme of things. And now you have new product versus those other products, which are, not only insurance costs have rose a lot, but you have old product, right? That is tough to do a lot
with an old product, right? I mean, people don't realize that there is structured obsolescence. Look, I own 70s vintage products. I can tell you, there's only so much you can do. People tell me they're going to do this and they're going to do that. And I'm like, this is pretty good. You can spend all the money you want, but if your resident doesn't pay you for that, what's the point of having like the greatest renovation on your property? Like, what are you really going to do with it? So that's the question a lot of people couldn't answer. And the other deal is, look, our hard costs of construction now are in the low to mid 130,000 a unit. So if my hard cost of construction is low to mid 130,000 a unit for a new product, I'm going to take that trade all day, every day versus buying something 30, 40, 50 years old. And people don't, by the way, realize that a 1980 vintage product is 44 years old today. I mean, people don't realize that. That's a long time ago, basically. So those are some of the big factors. But again, when you explain it to people, I understand in the frenzy and hype, everybody wants to go to places where they are comfortable with. But if you're doing what everyone else is doing, you're going to be living the life and getting the returns that everyone else is getting, which is usually average or below average at best.
Yep. Very well said. Again, Omar Khan, boardwalkwealth.com. So what's the second maybe secret or strategy that you're using to uncover hidden gems besides just going against the grain right now and growing multifamily markets?
So look, the second hidden gem isn't something as hidden, but I think people don't really pay attention to it, is paying slightly above market wages to your people. In this way, you can attract the highest quality people. So this is something that I understand there's a constant push and pull. And by the way, I have that as well, because anytime I'm hiring somebody, I have to think, okay, well, how do I pay for this person? What do I do? And the typical MO for a lot of private capital people is, well, why you want to hire somebody, you tell them, well, when all of these 5 things happen, you can take a share of the GP or something. Well, top performers don't really give a shit. They've got a lot of options. So you have to pay above market salaries. number one. You have to bonus them generously, because every time we bought on somebody who's a top performer, they've been one top performer does the work of like five mediocre people. And every single time we bought on, we've compromised, we bought on somebody mediocre, we have just been frustrated beyond belief. So the second big thing to uncovering hidden gems, not just generally in the markets you're in, but also in other markets, is getting top quality people and paying them top quality money.
Okay, that makes perfect sense, right? Because you got to build the team to build everything you're doing. So make sure you're paying above market and you're bonusing well top people to do hopefully 5x the work that an average performer would do. Okay, great. Well, let's keep going. What would you say the third thing is to perhaps uncovering hidden gems and/or growing a multifamily business would be?
Well, first of all, I don't want to give away all my secrets, right? So, but the third biggest gem I feel would be then picking a market where you can actually scale. So this is something that I've seen a lot of people falter, where they find a market which is good for, and they're trying to do work at the scale we're doing. And they find a market which is really good for, say, maybe a 20, 40, 100 unit sort of development. But after that, they stall out pretty quickly. So you have to have that combination of having a market which is performing better than the average and coming up, but also a market which allows you scalability. So I'll give you a simple example. You could have 100% success rate, but you only saw 2 deals as an example, right? 40 units each, 100 units each, whatever. Or you could have a 10% success rate, but you saw 100 deals in a market. So the scalability factor is also very important. And typically, wherever you can scale, those are also markets where you can find the right talent, and you have all those flywheel effects taking place as well. So in a combination, it's like identifying the right market, identifying the right people, and then within the context of the market, and I guess this applies to people as well, making sure that wherever you are is scalable. So what you don't have to do is then, once you've exhausted all your resources in this market and you only did 1 or 2 deals, now you got to go recreate the wheel and find something else.
Yeah, interesting. And let's talk about the Sioux Falls one. Let's get really, really micro here, right? So how many units are you building there now? What does that look like? And how did you determine that market would sustain that amount of units? And do you see yourself duplicating that with multiple projects to be able to scale the multifamily management?
Okay, so let me give you an example. So let me do the math right now. So what are we doing? 120, 144. We are building close to about 900 units there, 700 to 900 units there right now. We've got another about 1,000 units there that are in our current pipeline to build in and around Sioux Falls. So that gives you an idea. How did I pick that? I have a local partner there who's been telling me a lot about that market, Des Moines and Omaha to a certain degree. The problem with Omaha that we were seeing was that it was very hard to scale in Omaha, because there's a lot of people, but there's just not a lot of trades happening in that market, even though it's a great market. Sioux Falls was a good combination that I had local partners who I had a long-term relationship with. We were seeing the economic trend. Sioux Falls is in the top 15 most affordable places in America for a big city. It's also one of the fastest growing small tier cities in America. And now it's it's close to about 300,000 people in population. So as we learned by doing a lot of research in urban economics, there's tiers of cities. Cities have to go from 0 to 50, 50 to 150. 150 to 250, and the next step is 250 to 500. And the step there is because at each step that you grow, your growth becomes faster and faster. So the momentum goes faster and faster. Why does that happen? Because when you hit certain inflection points in your population, more and more national companies then need to have representation, and bigger businesses need to have representation in that metro. So it's a case of success building on itself. So Sioux Falls is an average. I think last year it grew by 2.3% population-wise. You're looking at places like Texas, where I live. I love Texas, but Texas grows at 1%, and Texas would have like the greatest year of its life. So when you have a place where you're growing 2x more than the next person, then when you have scale, and it's all geographically concentrated, you're able to get a lot of efficiencies because you can manage everything together. So that's what really attracts us about that business.
Yeah, I think that makes a lot of sense. I kind of liken it to maybe for buying a stock, right, that has a lot of opportunity for growth, and you can get it at a lower basis. Essentially, you're investing into this city that has a lot of opportunity for growth, and it's going to hit these inflection points when it does. Let's say it gets on, when you say the national brands, right? It's like a stock getting onto the New York Stock Exchange, or a stock getting onto something, and all of a sudden it's going to attract and it's going to compound the ability for the potential upside. And so you're essentially investing into a lower basis, if you think about it like a real estate investment, right, of a city. Also, hopefully, you said 130,000 a unit. That's compelling, right? If you can build for 130,000 a door, right? As I would make sure I caught that, right? And then you can scale that. That's compelling. Did I miss anything, Omar? Or am I
No, that's a hard cost of construction, and that's why it's very attractive. And I'll give you simple examples, right? Hard cost of construction in Dallas, Texas, where I live, are anywhere from like 180 to 190,000 a unit. Number one. Number two, the bigger problem there is that land costs here in Dallas or other markets similar to Dallas are at least like 25 to 35,000 a unit. Our land costs are 6 to 12,000 a unit. So it's all these little costs that you end up saving. And by the way, it's not like your rents are that different, man. I mean, you've seen, short of California or New York, rents for a similar type of product are pretty similar across the country. We have a 6-story elevator product in Sioux Falls, Blue on the Rain, and our 2 bedrooms go all the way up to $3,500.
Yeah, that makes perfect sense, right? The math just makes more sense. So you get $3,500. You're most expensive for a similar product in Texas that would not be that much different, and you're at $25K a unit for the land, or $6K versus $25 in Texas, and then you're at about $135 or $125 versus about $180 to $190, and it makes sense. Okay, great. Anything else to add to this before we go to the lightning round?
Oh, high level, that's it. I mean, the pitch, look, again, it's a lot of small little things that are intelligent, as opposed to one like, I didn't discover the concept of Sioux Falls or multifamily. Right? Obviously, it's doing a lot of small, intelligent things, but then having the conviction and courage to do them.
Yep. Perfect. Excellent. Well, Omar, let's dive right into the lightning round if you're ready now. By the way, you can learn more about Omar by going to boardwalkwealth.com, boardwalkwealth.com. All right, Omar, if you go back to your 20-year-old self, what's the one gold nugget make sure you tell yourself to do?
Oh, I would have told myself to probably buy NVIDIA stock or Amazon stock. Put all my money into it. That's what I probably told myself to do.
Excellent. Question number 2, what's the number one book you recommend or gifted most in the past year?
Oh, look, I'm a voracious reader, so things keep changing. You can see this is just a sample of like everything in the last year. So yeah, I'm the wrong guy to ask. I mean, there's a great book I read, which is a fiction book. It's called Babbitt. It's by an American author from 1920s. What is it? Yeah, Sinclair Lewis. This was one of the funniest fiction books I've ever read. I don't think it intended to be funny. But yeah, somebody wants to read fiction. Babbitt was a great book that I just recently read.
Excellent. Question number 3, what are you most curious about right now?
Right now, what I'm most curious about is where are interest rates going for the next year?
As am I. Question number 3, what's the number one way you are using ChatGPT in your business?
My chief of staff and other people within HR and other people, they use it. I typically use it anytime I want to have something. I want to get something, but it's less and less me. It's more my assistant and chief of staff that use it.
Okay. Next question. Number one leadership quote or theme that you strive to live by?
Oh, well, see, I'm trying to get better at leadership, so I'm the wrong person to ask. But a thing that one of my mentors once told me is that the graveyard is filled with irreplaceable people.
I like that. That's good. You know, another one I heard today or yesterday from Mark Cuban. He says, when you're running with elephants, right? There's 2 people. There's the quick and the dead, right? And the whole concept was like, if you're trying to break into an industry where there's a lot of like, big time players that have established the status quo and the big money, the big markets. And so he talked about the ability to be nimble and to be able to really be quick, right? To be able to move. So any thoughts on that, Omar?
No, I think it's a good point. This being either you're fast or you're dead. That's really good. I'm going to copy that.
Yeah. Last question. As after you've helped so many people build wealth, right? And you building a lot of wealth with multifamily investments, what would you say is the number one way that you stay centered in your values and also stay encouraged to charge forward to reach even higher heights?
So sorry, can you say that again? You cut out.
Yeah. The number one way that you stay centered, like in your values, right? What's the one thing that you practice to stay centered in your values and then charge forward to reach high heights? Yeah.
I got a wife. It's pretty easy to be centered when you have a wife.
Yeah.
It's really not that hard. Trust me. I mean, you got a wife, right? Have you?
Yeah.
You do. Yeah, trust me. I got a wife. She makes it pretty easy for me to be centered. Don't worry.
Excellent. Omar, for our listeners who want to get in touch with you, would you mind one last time? What's the best place to find you?
Yeah, look, the best place to find us is to go to boardwalkwealth.com. boardwalkwealth.com. You can join my mailing list. It's right. The form's right on the homepage. Again, boardwalkwealth.com.
Awesome. Omar, thanks for being on the show. Also want to thank our listeners for listening to an episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust and or investing with someone like Omar Khan, who has a proven track record of multifamily investments and performance, is a great way for you to create and preserve more wealth. If you want to learn ways to defer capital gains taxes on cryptocurrency, businesses, or real estate without using the 1031 exchange, go to capitalgainstaxsolutions.com. We offer the deferred sales trust as an option as well. We just released the best 1031 exit plan. This gives you the ability to use a 1031 exchange, or if it fails, to have a deferred sales trust as a backup plan. Friends don't let friends overpay for a 1031, and friends don't let friends do a 1031 without having an alternative. Make sure you go to experttaxsecrets.com to learn all about ways to defer capital gains taxes using a 1031 or a deferred sales trust. That being said, appreciate everyone listening out there.